The $95,000 trap. Everyone is watching Bitcoin break through $95,000. The headlines are celebrating. Social media is electric. Retail investors are posting screenshots of their portfolios. Analysts are revising their year-end targets upward. The sentiment is clear. This is confirmation. This is validation. This is the beginning of the next leg up. That's not the story. The story is what happened in the 48 hours before the breakout. The story is who was buying, who was selling, and what they knew that you didn't. The story is a carefully constructed moment designed to transfer wealth from those who react to those who plan. And if you don't understand the mechanics of what just occurred, you will repeat the same mistake the next time this pattern emerges. Let me show you what actually happened. The false narrative. The dominant narrative is simple. Bitcoin broke resistance. Momentum is strong. Fear of missing out is spreading. Retail investors who sat on the sidelines through the consolidation are now entering. New all-time highs are within reach. Institutional adoption is accelerating. The bull market is confirmed. This narrative is emotionally satisfying. It feels like progress. It feels like the market is rewarding those who believed. But narratives are designed to do one thing: capture attention and trigger behavior. And the behavior they trigger is almost always the same. Retail investors see the breakout. They feel the fear of missing out. They check their portfolios. They look at the price history. They see that Bitcoin has moved 10% in 3 days. They convince themselves that if they don't act now, they will miss the opportunity. So they buy. They buy at 95,000. They buy at 96,000. They buy as the momentum accelerates and the headlines multiply. This is the intended outcome. Because while retail investors are buying into the breakout, someone else is selling into that demand. The hidden data. Let's start with exchange flows. In the 72 hours leading up to the breakout, Bitcoin exchange inflows surged. Large wallets, addresses holding more than 1,000 Bitcoin, began moving coins to exchanges. Not all at once, not in a way that would trigger alarm, but steadily, methodically. This is not the behavior of holders who believe a major rally is beginning. This is distribution. Now look at the timing. The breakout occurred on a Sunday evening, U.S. time. Low liquidity, thin order books. A moment when a coordinated move can create the appearance of overwhelming demand without requiring overwhelming capital. The price spike triggered stop-loss orders. It triggered automated trading algorithms. It triggered margin calls on short positions. All of this added to the upward pressure. But the buying was not organic. It was mechanical. It was a chain reaction initiated by a calculated move in a low liquidity environment. And while retail investors were celebrating the breakout, exchange reserves were rising. Coins were being deposited. Supply was being prepared for sale. The liquidity illusion. Here's what most retail investors don't understand about liquidity. A breakout doesn't require belief. It requires volume, and volume can be manufactured. When a large holder wants to sell a significant position, they cannot simply dump coins onto the market. That would collapse the price and destroy their exit. Instead, they need demand. They need buyers who are emotionally committed to purchasing at elevated prices. So they create the conditions for demand. They initiate a move that breaks a key psychological level. They trigger technical indicators. They generate headlines. They create the appearance of momentum. Retail investors see the breakout and interpret it as strength. They see the volume and interpret it as confirmation. They enter the market expecting continuation, but the volume they see is not new buyers entering, it's existing holders exiting into the demand that the breakout created. This is not a conspiracy. This is market structure. Large holders understand that liquidity is highest during emotional moments. They understand that retail investors are most willing to buy at the top of a move, not the bottom. They understand that the best time to sell is when everyone else wants to buy, and they structure their exits accordingly. The power play now, let's talk about who was positioned before the breakout. Over the past 6 weeks, as Bitcoin consolidated between 85,000 and 92,000, a specific group of wallets was accumulating. Not the wallets that move coins to exchanges, not the wallets that trade actively, the wallets that don't move. Long-term holder supply, coins that haven't moved in more than 6 months, increased during the consolidation. These are the patient holders, the ones who accumulate quietly while retail investors are bored or fearful. The ones who understand that consolidation is not stagnation, it's preparation. They were buying between 85 and 90,000. While retail investors were waiting for confirmation, while analysts were debating whether the bull market was over, while sentiment was neutral to negative. This is the pattern. Smart money accumulates during uncertainty. They buy when no one is paying attention. They buy when the headlines are quiet. They buy when prices are stable and volatility is low. Then they wait. They wait for the breakout. They wait for the headlines. They wait for retail investors to enter. And then they don't sell, because they're not trading the breakout. They're trading the cycle. The calendar effect. There's another layer to this that almost no one is discussing. We are 7 days into January. Historically, January is a strong month for Bitcoin. The January effect is well documented across financial markets. Institutional capital re-enters after year-end tax planning, new fiscal year budgets are deployed, and psychological resets create renewed buying interest. But the strongest performance typically occurs in the second half of January, not the first week. So why the early breakout? Because someone wanted to front-run the expected demand. They wanted to establish positions before the calendar-driven buying begins. They wanted to sell into the initial wave of enthusiasm before the real capital arrives. This is not accidental timing. This is strategic positioning by participants who understand market cycles better than retail investors ever will. The wealth transfer. Here's the framework you need to understand. Markets do not move randomly. They move in patterns designed to transfer wealth from the impatient to the patient, from the reactive to the strategic, from those who trade emotions to those who trade structures. The breakout at 95,000 was not the beginning of a rally. It was the trigger for a transfer. Retail investors who bought the breakout are now holding positions at elevated prices. They bought because they felt they had to. They bought because the momentum was undeniable. They bought because they didn't want to miss out. But the holders who accumulated below 90,000 didn't sell. They're still holding because they understand that 95,000 is not the target. It's a milestone. The whales who moved coins to exchanges are now waiting. They distributed a portion of their holdings into the breakout demand. They took profits at levels retail investors are just now entering, and the long-term holders added to their positions during the consolidation when no one was watching. This is the wealth transfer. Retail investors traded fear of missing out for exposure at high prices. Whales traded patience for profit. Long-term holders traded boredom for accumulation. And the cycle continues. The framework. If you want to avoid being on the wrong side of this pattern, you need to change how you interpret price action. A breakout is not confirmation, it's a liquidity event. Volume is not strength, it's opportunity for distribution. Momentum is not a signal to enter, it's a signal that someone else is exiting. Here's what to watch instead. Watch exchange flows during consolidation. If coins are leaving exchanges and moving to cold storage, accumulation is happening. If coins are moving to exchanges during breakouts, distribution is happening. Watch long-term holder supply. If it's increasing during periods of low volatility, smart money is positioning. If it's decreasing during periods of high volatility, they're taking profits. Watch the timing. Breakouts that occur during low liquidity hours, on weekends, or at the beginning of historically strong periods are often engineered to maximize the transfer of wealth from reactive buyers to strategic sellers. Watch the headlines. When the narrative becomes unanimous, when everyone agrees on the direction, when the fear of missing out becomes overwhelming, that's when you should be most cautious. Because markets reward those who act when others are uncertain, not when others are convinced. The open-loop Bitcoin is now above 95,000. Retail investors are entering. Media coverage is intensifying. Analysts are raising targets. But exchange reserves are rising. Large wallets are moving coins. Long-term holders are not selling. Someone is preparing for something. The question is not whether Bitcoin will go higher. The question is, when the next move comes, who will be positioned correctly? And more importantly, will you recognize the pattern before you become part of the transfer? The wealth isn't being created right now. It's being redistributed, and the redistribution isn't finished. Watch what happens in the next 2 weeks. Watch the exchange flows. Watch who's selling into strength. Watch who's accumulating on any pullback, because the breakout at 95,000 wasn't the story. It was the setup.